All right, I'm your host, Frederick Middlebrooks, and we are talking creative financing. A lot of people have been getting priced out of the market and have been getting discouraged because interest rates have gone up starting last year in 2022, and home prices have continued to go up and hold steady as they slowly continue to increase as well. So that drop that a lot of people were waiting on is not seeming like it's going to be happening. Not that I thought it was going to happen anyways, but I think a lot of people are realizing that we are in the new norm of what we are seeing with home prices, and home prices are expected to continue to slightly increase as well. So with that, I want to provide you with some creative financing options. So if you don't yet qualify to purchase a home through the traditional means of a FHA, VA loan, or a conventional mortgage, USDA mortgage, whichever loan option best suits your needs. These are some other options that you might want to consider, which can still help you qualify to be able to purchase that home and start building some wealth. So let's get creative with these creative financing strategies. These are the financing options we're going to discuss. There are 10 of them, interest-only loans, and they are in no particular order. So interest-only loans, seller financing, contract for deed, assume the seller's mortgage, retirement account, lease purchase, private mortgages, crowdfunding, hard money, and cash out refinance. Now, assume the seller's mortgage is going to be one that you might want to pay attention to as well. It will require you to have a little bit more in-depth with the seller on the purchase of the home that you're looking to purchase. And maybe you want to get your agent involved in having that conversation as well. But this is one way that you could actually help your qualification, because if the seller had purchased their home prior to 2022, it's a high possibility that they have a mortgage with an interest rate that is less than what today's interest rates are. So I'll talk a little bit about how that can benefit you as well. So we'll get started with interest-only loans. So I wanted to go a little bit over the pros and the cons. Again, this is not an exhaustive list. There can be some more pros to each one of these, as well as some more cons to each one of these. But I just wanted to hit some of the high points of what I felt were the pros and the cons for each one of these creative financing options. So for the pro side, lower qualification requirement. When you purchase a home and you finance it under an interest-only loan, you're only paying the interest. So for a $300,000 home, the principal and interest for a $300,000 loan, if you have a 6% interest rate over 30 years, the principal and interest payment is $1,798.65. If you only pay the interest, meaning that you're not paying any principal, that means that the interest-only portion of that loan is $1,500 a month. That's almost $300 less than what you're paying if you pay principal and interest. Now, you're still responsible for paying taxes and insurance, and that's going to vary depending upon where the home is located that you purchase, as well as the homeowner's insurance that you get for that property as well. So that's going to vary. However, you don't have to pay that principal. So that extra $300 can help you qualify for a home. Now, the cons is that you are not paying down the principal balance. Again, you're only paying interest, not principal. And so the lump sum, oftentimes when you get ready to sell this home and move on to your next home, you're going to have a lump sum payment at the end. And that's another thing that I listed under the cons, is that you could have a big lump sum payment. Whereas when you're paying principal and interest payments, let's say you purchased that $300,000 home and you stay there for 10 years. If you're paying principal and interest, at the end of 10 years, you don't owe $300,000, you owe somewhere less than that. So that decreases the amount that you owe when you go to sell the home on that remaining outstanding balance of the loan, because you've been paying down some of the principal balance with each mortgage payment. However, your lump sum is going to be larger for this interest only. And lastly, for the cons, it's going to affect how much equity you have in the home available if you ever wanted to access equity for, say, a cash out refinance. So cash out refinances, in many cases, a lot of lenders can go up to 80% of the value of the home. This doesn't mean that you can't do a cash out refinance, because if you purchase a $300,000 home, even making interest-only payments, assuming that home has appreciated over time, it will be worth more in the future. So you can have some equity there, but you haven't paid the principal balance down any. So it's going to affect how much equity you have there. So these are some things that I do want you to just be aware of when you are considering these options. There are pros that can help you get into a home, but there are also some cons along with it as well. And this is one program where I would personally look at utilizing it for a shorter period of time, whether it be to get some things right with your credit or to save up some money for a down payment when you go to refinance this thing into a different loan. So I would not look at spending 30 years or 40 years in an interest-only loan and just paying interest to the bank without putting anything towards the principal. So that's just my personal take on it. But again, something for you to consider. Moving along, we've got seller financing. With seller financing, some of the pros, we got potentially easier qualification standards. Oftentimes, if you are not able to qualify for a home via the traditional means, seller financing may be an option, and the sellers may offer you decreased finance or easier qualification standards, I should say, flexible down payment requirements. So traditionally, FHA might require a 3.5% down payment. A conventional might require a 3% if you're a first-time home buyer, or maybe a 5%. But maybe through seller financing, you can get that down payment amount that you have to pay down as well, because this is all in the seller's hands. So you can also have cheaper closing costs as well. Some things such as an appraisal, you might not have to pay for an appraisal because, again, the seller is financing this thing. The seller knows how much home is going to, how much the home is going to go for, because whatever the price is that you all agreed upon, say if the price is 300, we'll just stick with that number, then the seller is okay with utilizing that number. They don't need to say, okay, now I need for you to pay for an appraisal of my home to make sure my home is worth 300. In many cases, the seller will just forego that appraisal and some of the other fees that you may need. You may need an attorney's fees to make sure that this is going to be a legit transaction. And so I would recommend, even through seller financing, have an attorney drawing up all the contracts and make sure that it's all in ink on paper. But you do want to just be aware that, it could be cheaper closing costs. So this could be an option for you. But under the cons, you could pay a higher interest rate. Again, the seller is helping you by lowering those qualification standards, but that also comes with some risk. And so a lot of times, to help offset that risk, you do have an increased interest rate. You also may have a balloon payment at the end. So sometimes the seller doesn't want to finance you for 30 years, especially if you got a seller who might be 60 years old or 70 years old. They might not want to finance you for the next 30 years. Maybe they say, look, I'm willing to help you out. I'll finance you for the next 5 years. And at the end of that 5 years, you owe me the rest of the money. Or 3 years. And at the end of that 3 years, you owe me all the remaining balance of the loan. And if you can't pay it, then I get my house back. So that is a possibility. And that large lump sum that you owe at the end is called a balloon payment. And so it's possible that you could, in a shorter period of time, 3 to 5 years, if the seller doesn't want to finance you for 30 years, have to pay that full balloon payment at the end of the loan. So something you want to be aware of. And then a due on sale clause. So the due on sale clause, if the seller is considering seller financing, you want to know whether or not that seller has a mortgage on the property. Because if that seller has a mortgage on the property, sometimes the lender, or it's in the mortgage stipulations for that mortgage that they have, states that at the time that the seller sells this property, the remaining balance is due to be paid to the lender. So if that seller owes $200,000 left on their mortgage, at the time that they sell, the remaining balance is due to be paid to the lender, hence the due on sale clause. And that's something you're going to want to know, because as soon as that seller pays or sells that property to you, they have to pay out the remaining balance. And if the seller's not even aware of that, then that can really cause some issues with the transaction as well. And you want this to be something that is beneficial for both sides of the transaction. So again, you want to know whether or not the seller owns their home free and clear, or whether it's financed, because if it's financed, you want to know if there's a due on sale clause in that financing. So if they transfer this over to you, are they going to have to then pay off the remaining balance of the loan that they have on it? So contract for deed, I'll flip back and forth between contract for deed and seller financing, and you'll see there's only one thing different. And that's under the con side, which is a higher risk of loss in default. So a contract for deed, very similar to seller financing. Difference being that in a contract for deed, the seller retains some ownership in the property. So the seller's still on the title to the property. So whereas in seller financing, it operates as if you have gotten a loan, and if you were to get a loan and purchase a home, now you have the deed to the home, you're on the title to the home, you have ownership of the home. But with a contract for deed, the seller still has ownership in the home. And because of that, if you were to default on the loan, i.e., if you just stop paying the seller the monthly payments you were supposed to pay the seller doesn't have to go through the same legal course of action in terms of the foreclosure proceedings, which could take months or in some states even years, to foreclose on the property, have it go through the foreclosure sale and everything like that, that eats up months and months and months of time. For a contract for deed, if you default, because the seller still owns the property, they can just evict you. You're essentially more or less like a tenant, because with a contract for deed, you have a contract that states you are to pay the seller a certain amount of money every month toward the purchase of the home. The seller retains ownership of the home. And once you have paid the seller in full for the price that they are owed for the home, at that point, everything transfers over to you and you get the deed, hence the contract for deed. Once you have fulfilled the terms of the contract, then you get the deed. So this is a way that maybe the seller's not willing or interested in seller financing. This is a way that you could also potentially work your way toward ownership, because you're still going to be living in the property and everything. The seller retains ownership, but all of your payments still go towards the balance of the home according to the contract. The difference is you don't actually get the deed until you have fulfilled the contract. So something you definitely want to keep in mind if you happen to do a contract for deed is that you won't actually have the full rights to the home until you fulfill the contract, but it could be a way to convince the seller that, you know what, I'm serious about wanting to purchase your home. I'm responsible. I'm not going to miss any payments, and you definitely want to be responsible and not miss any payments, because if you do, again, the seller can just evict you. They don't have to go through this whole foreclosure proceeding because they own the property. So you want to be aware of that as well, that the length of time to get you out of the property if you default in a contract for deed is condensed compared to if you default and you own the property outright. So that's contract for deed. Moving on, assume the seller's mortgage. So I mentioned this a little bit briefly earlier. However, the pros, potentially lower interest rate. Now, that's what I mentioned earlier. So if you have a seller that purchased their home, let's say in 2019, and they have a 3% interest rate, some mortgages can be assumable. So you also want to check to see what type of mortgage the seller has and if that mortgage is assumable. So some mortgages are assumable. So what that means is that if the seller has a 30-year mortgage, and let's say they're 3 years into that mortgage or 5 years into that mortgage, and they decide to sell their home and you decide to purchase it, you can check with the seller and say, hey, what kind of mortgage do you have on this home? Is your mortgage assumable? And if so, you can go to that lender, and if you qualify to assume the seller's mortgage, meaning that you do have to make enough income, your debt has to be low enough, and your credit score needs to be high enough. So it's like qualifying for a mortgage. However, if the seller has a 3% interest rate, then you can qualify for a lower mortgage payment than if you were to go get a brand new mortgage in today's market at like a 6.5% interest rate. So something to keep in mind. You definitely want to know what the seller's current interest rate is. And then if you qualify to take on their mortgage, this could be a more advantageous option for you. So you also would have lower closing costs as well by assuming the seller's mortgage. In many cases, depending upon the lender, you don't even have to get an appraisal done, because again, the seller's already under a mortgage for this property. So that could save you $550, $600 on an appraisal right there, because there's already been an appraisal done on this property that already has a mortgage on it. You're just assuming the current mortgage. Now, for some of the cons, you could have higher down payment costs, or a second mortgage might be required. And so by that, what I mean is that your down payment cost, if you have a seller who is going to let you assume their mortgage, let's say the seller purchased the home at $300,000. Let's say that the seller owes $230,000 left on the mortgage. They still owe that $230,000. They purchased the home for $300,000. So when they go to sell you the home for $300,000, if you assume the seller's mortgage, you're assuming that $230,000. But the seller sold you the home for $300,000, which means there's $70,000 more that still needs to be accounted for and paid to the seller, because the seller is selling you the home for $300,000. Or let's say the seller purchased it for $300,000, but now the home is worth $325,000, and that's what the seller is selling it for. In any case, if you're assuming $230,000, but it's worth $325,000 now, that's $95,000 that you need to be able to pay the seller. If you don't have $95,000 in the bank account, which would be your down payment to, and assuming the seller's mortgage, you would have to put $95,000 down to pay towards this, to pay the seller the rest of what they're owed. Then you have to look at getting a second mortgage to cover that $95,000. So you can assume the seller's mortgage, but now you need to look at going and getting a second mortgage. And oftentimes those second mortgages come at higher interest rates, because second mortgages are riskier than primary mortgages. So something you want to consider as well is you could have a higher interest rate second mortgage if you have to go with a second mortgage because you don't have the money to pay the down payment for the primary mortgage. And lastly, under the cons, I put limited loan options. Obviously, if you're assuming the seller's mortgage, you are limited to the type of mortgage that the seller has, and only certain types of mortgages can be assumed. So you do want to keep that in mind, that, you know what, your loan options are going to be limited. However, on the positive side, you could get that much lower interest rate with those lower payments that can help you qualify and get this home that you're wanting to get. Moving on, retirement account. So the pros, and first I will say a lot of people aren't aware of this. You can use your retirement account to purchase real estate, and there's a lot of different ways that you can do this. I'm going to try and keep the focus more on purchasing primary, but I'll touch a little bit on investment properties, because you have some people that do what's called a self-directed IRA in order to buy investment properties through retirement accounts or individual retirement accounts. And that's something that you can do as well. But you can also tap into money in your retirement account and withdraw that early without having a penalty. And I mentioned that as one of the pros as well, in order to purchase a home or to have the down payment and closing costs, because as we know, that has increased as well. If you're purchasing let's say you're purchasing a $400,000 home, that could be $14,000 just for the down payment if you're going under a FHA loan. If you're purchasing under a conventional and it's a 5% that you're looking at, you'd be looking at $20,000. So these are things that, you know, you might not have $20,000 on hand. You might not have 14, and that's just for the down payment. You could have another $8, $9, $10, $11,000 in closing costs, all depending upon the home that you're purchasing, the property taxes that you owe, the homeowner's insurance. All of these things play a factor. So you could easily spend $30,000, $40,000 that you need to have up front. And if you don't have that, maybe you have that in a retirement account. So you can tap into that retirement account and use those funds to be able to make your down payment and closing costs. Because if you already qualify for the loan based on your income and your debt and your credit score, but you just don't have the money for down payment and closing costs, this is a way that you can get the money for the down payment and closing costs by tapping into the funds in your retirement account. And again, when you tap into those funds and use them to purchase a home that you're going to live in many cases, you'll definitely want to check with your brokerage or wherever your retirement funds are. But in many cases, when you're withdrawing early for the purpose of purchasing real estate, you can withdraw those funds, like I said, in many cases without incurring a penalty for early withdrawal. So also, if you have a lot of money in your retirement account, you can buy a home outright with just all the money in your retirement account, and there's no credit check required. And if you are doing this out of a 401k, let's say you are borrowing money against your retirement account, when you pay that money back with interest, you are paying yourself back with interest, not paying a bank back with interest. So that's another plus as well. You're paying yourself back by paying a bank. Now, on the con side, I did mention that you will be missing on investment gains. So obviously, if you withdraw money from your retirement account, that money is no longer earning you money, is no longer gaining value anymore because you withdrew it for another purpose. Keep in mind, though, you're doing this to purchase a home, which is going to be appreciating over the years. So that money is still going to be earning you value, just in a different place. It's going to be in a home that you own, which is going to be building equity through appreciation, vice in a retirement account that is growing via the stock market or via the bond market. So limited loan options also. So again, you don't have all of the options available to you when you are pulling money out for a retirement account, but that's something that you will definitely want to talk a little bit more with your lender about and look at what some of the rules are with the 401k or your IRA if you have your retirement money in an individual retirement account as well. So moving on from there, we've got lease purchase. A lease purchase, if you are not aware, is where you lease a home with an option to purchase it at a later date. That later date is not indefinitely. There's usually a fixed amount of time, somewhere between 3 to 5 years, depending upon who you go with for your lease purchase company. But some of the pros for a lease purchase is that it can help you save money for your down payment, which tends to be the reason that a lot of people can't purchase is they don't have $20,000, $30,000 saved for the down payment and closing costs. So by doing a lease purchase, you can lease the home that you want to buy. So with these lease purchases, a lot of times, and again, this can vary depending upon the company that you choose, but a lot of times what happens is that you go to a company that is a lease purchase company. They look at your income, your debt, your credit score, everything that a traditional lender would look at. However, the qualification standards for lease purchase tend to be a little bit less than what they are for traditional financing through a FHA or conventional mortgage. So they look at all your stuff and they decide, yep, you qualify for our lease purchase program up to $250,000. So you go find a home for $250,000. They purchase the home and then write you a lease on the home. So now you're leasing the home that you want to buy from the company. And so you're paying them rent. And some companies will also allow a portion of that rental payment to go towards a savings account to save up for the down payment. So whenever you get to the point where you do qualify to purchase that home, you already have some savings that have been built up over time to help you purchase that property as well. So that's kind of how lease purchase works with a lot of companies out there, not all of them. So you definitely want to check with the company that you're looking to go to if you do consider taking this route. However, it can be an option for you to purchase the home that you're looking to purchase and live in it. And as I also mentioned in the pro, you don't have any moving expenses or hassle because, again, you're living in the property that you want to buy. You're just leasing it from the company that bought it for you. You're leasing it from them until at a time where you can qualify for financing, and then you can purchase that home from them at a set price. And that price is set before you purchase the home. So if you purchase it in year one, generally it's a particular price. But if you don't purchase it in year one and you wait till year two, that price generally goes up. Year three, it goes up again. And a lot of times, again, there is a cutoff. So a lot of times you'll have 5 years in this lease purchase agreement. And if you can't purchase that home within that 5 years, then you've got to move out. A lot of times the lease purchase company will try to sell the home, get their money back, and keep it moving, because they're not looking to lease to you indefinitely. The whole idea is for you to be able to purchase this home back from them. So it does allow you time to repair your credit as well. If credit repair is something that needs to happen in order for you to be able to purchase, having a lease purchase is something that will allow you that time. So some of the cons, you can pay higher rent costs. And this is especially true if you have some of that money in your rent that you pay on the lease going toward a savings account to save up for your down payment. They can increase the rent amount to help compensate for some of that money that will be coming back to you for when you go purchase that home. So you could pay higher rent costs. And again, like I said earlier, you may not qualify at the end of that 3 or 5 years to be able to purchase that home from them. Most of that's going to be dependent upon you being able to position yourself within that period of time that you're given to be able to purchase the home, keeping in mind that every year the price of that home is probably going to be going up. So they purchase that home for you from $250, but the next year it might go up to $265. And so now you need to be able to qualify at $265. And then the following year after that, it might go to $278. And so by that third year, if you're waiting that long, you need to qualify for, in the fourth year, it could be over 300. Whatever it is, you need to be prepared to get aggressive in saving what you need to save quickly, working on your credit as quickly as you can, and doing what needs to be done so that you can qualify for traditional financing through a lender so that you can purchase this home as quickly as possible from them and not pay them as much money. But it is an option for you to be able to purchase a home. Private mortgages. So private mortgages are mortgages that come from private individuals or companies, vice, government-backed loans such as a FHA, VA, or USDA loan. So generally with private mortgages, you have a quicker approval process, flexible qualification standards, and that should have been out. The no moving or hassle expenses, that's a typo. So I apologize for that. That should not be in this one. But you do have a quicker approval process, and you do have flexible qualification standards. Because again, with private mortgages, they don't have to write these to government standards of an FHA loan, because these aren't FHA mortgages. This is a company that's loaning you money. So they can write these to whatever standards they want to write them to. So that's something that can play to your benefit in terms of having flexible qualification standards. It can make it easier for you to be able to qualify if you don't qualify for a traditional loan. And their approval processes oftentimes faster. So with the cons, higher interest rates. A lot of times when you see qualification standards being decreased to get you into a home, that's going to come at a cost of upfront higher down payment, higher closing costs, and or higher interest rates. So that's something you want to be aware of. Anytime people are lowering the standards or lowering that bar to get you into a home, they're going to want to compensate for that additional risk that they're taking. And that compensation generally comes in the form of you paying a higher down payment or you paying higher interest rates. So that also is true for private mortgages. You will pay higher interest rates oftentimes with them. You could have extra fees and closing costs as well. And it could be it could possibly be a shorter loan term as well. So you might get a private mortgage that only wants to lend you money for the next 5 years. So it's like, hey, I'm lending you this for the next 5 years at this set interest rate to purchase this home. Get your stuff together within that 5 years, because after 5 years, I need the rest of my money. And so that's going to have that balloon payment that we talked about. After that 5 years, you're going to owe the rest of your money. So within that 5-year period, and you really want to work closer to the 2 to 3 year period, get yourself in a position to where you can go to a traditional lender to get a 30-year mortgage so that you can stay in this home long-term under better financing terms with lower interest rates. But again, this is something that you can use to get your foot in the door so that you can at least purchase that $250,000 home or that $300,000 home today, rather than waiting 2 to 3 years down the road, where now you're going to pay $285 for that $250 that's today, or you're going to pay $335 for that $300 for that home that you could get for $300,000 today, because again, home prices are continuing to rise. So something you want to be aware of. But private mortgages, that is what they are, and those are some of the pros and cons of it. Moving on to crowdfunding. Crowdfunding is something that you typically see a lot with investment properties. You can use crowdfunding to purchase a primary residence, but you need to have some generous people like friends and family who you're going to crowdfund from through a GoFundMe campaign or something to help you with your down payment and closing costs. or help you purchase the whole home outright if you got a lot of friends. But if not, and you're looking to purchase an investment property, crowdfunding is an option. So crowdfunding is basically allows you to pool money together with a lot of different investors for the purpose of buying real estate. And that's one of the pros of it, is that no one person or in no one entity is taking on all of the risk for financing a $300,000 home. One person can say, okay, I'm gonna put 10,000 in, I'm gonna put 20,000 in, I'm gonna put 5,000 in, whatever that amount is. People can pool their money together to help you purchase real estate. And this allows investors to earn returns on a small investment. Again, real estate is a business outside of the people who are, obviously purchasing it for their primary residence. But real estate is a business for most people, including mortgage lenders and real estate investors. And so it allows investors to earn returns on a small investment. So instead of an investor saying, oh, I got to have $300,000 that I'm going to give you and trust that you're going to make the payments, an investor can say, I'll take a piece of that pie, I'll put 5,000 in and earn a return on my 5,000 rather than having to give you the whole 300. So you can also allows you to bypass the loan process, because again, if you get enough money together from crowdfunding, you just go purchase the home with all the money that's been pooled together from the investors. You don't need a lender to go and purchase this home. So that can be another pro of crowdfunding as well, particularly if you're looking to purchase an investment property. Some of the cons could be that you're on the hook for an unprofitable investment. Now, this can change depending upon how you structure your deals with the investors that are crowdfunding with you. For example, if you are going to invest in a property that I'm looking to buy, then you might say, okay, I've got $20,000 here, I'm gonna invest in you. And I'll say, okay, let's say we work out an agreement where I'm going to guarantee you 3% or 4% return on your investment. So I go and take your money as well as all the other individual investors who have crowdfunded with me. I go and take all of that money, I go purchase this home. Now, if I'm not able to rent that home for what I need to rent it for, that duplex or quadruplex or apartment building, whatever it might be, if I'm not able to earn what I'm hoping to earn on it so that I can pay all of my investors what they are owed, as well as make some money off of this, then I'm in an unprofitable investment, but I'm still on the hook for all these investors that are guaranteed a 4% return on their investment. So this guy that gave me $20,000, I said, hey, I'm gonna give you 3% back, or I'm gonna give you 4% back. Even if I'm not making money, if it's in our contract that I guaranteed him a return, I still have to pay him his return on what he's owed according to our contract, regardless of the fact that I'm not making money on this investment. So that's something you want to be aware of. And you might think, okay, well, I just won't guarantee a return. He gets paid if I'm profitable. That could move some investors out of the door for you, because some people want to be guaranteed a return if they're putting up however much money to help crowdfund for a real estate investment that you're looking to do. So something that you want to be aware of, but I put it under the con because you could be on the hook for an unprofitable investment. And as an investor vice owner, you also have no control and the returns are smaller. So that is a con if you are an investor vice the owner. So I have been speaking about this as if you are the owner and have investors investing in a property that you are wanting to go purchase. However, if you are one of the investors instead of the owner, when you invest that money, you are guaranteed the return according to the contract, but you don't have any control over that property. That property has a manager, and that's who controls what happens with that property, the rents and everything like that. You are just going to get the rate of return according to the contract that you agreed upon with the owner of that property. So also, your returns are generally a little bit smaller than what they would be if you just own the property outright, because the owner has to make money on this thing as well. So moving along, hard money loans. This is another loan that is heavily known in the investment world. But again, if you're looking to get an investment property, it is a route to take. It is not a route that I would strongly consider if you're looking to purchase a primary residence. And I will say, because of the cons, starting on the con side, high interest rates. Hard money loans have some of the highest interest rates in real estate lending. Hard money loans have some of the highest interest rates in real estate lending. People do not want to stay in hard money loans for long. A lot of real estate investors use hard money loans for fix and flips, meaning that they buy a home that needs to be fixed up and repaired and they want to flip it, so they use a hard money loan. But the interest rates are so high, they don't want to stay in that hard money loan for any more than like 2 or 3 months or 4 months, because it's costing a lot of money to have that hard money loan. So what are the pros of it? They do have lower qualification standards and a quicker approval process. So you can get access to hard money loans a lot quicker and a lot easier than what you can get access to traditional financing to be able to purchase a home. But you need to be aware of the higher interest rates and the shorter loan terms as well. Hard money loans are generally, again, because of those super high interest rates, they're not for 30-year terms. You're getting a hard money loan for maybe a year, maybe 3 years, and you really don't even want to be in it a year. You want to be in it maybe 2 months, 3 months, 4 months, 5 months tops, but you don't want to be a long time in a hard money loan. So something you want to be aware of, really, really high interest rates. You really want to work your numbers and know what you're doing if you get into a hard money situation, because you need to be able to get that hard money loan paid off. I would not consider this unless you are an experienced real estate investor, or if you have someone who is a experienced real estate investor working with you for the purchase of a property. But this is not an option that I would consider personally for purchasing a primary residence. Cash out refi. So to round it out, cash out refinance. The pros, this gives you access to a large loan amount. If you've got a lot of equity in your home because the market has just run up, i.e. you purchased your home in 2019 or 2020, and now your home has over $100,000 worth of equity because the home prices just shot straight up. Well, now you have a lot of money that you could potentially access out of your home, and those funds can be used for anything. You can use that fund to go on a vacation. You can use it to renovate your home. You can use it to add a whole west wing to your home if you wanted to. You could use it for debt consolidation, because we are in an inflationary period right now, and interest rates are higher, but also the cost of goods and services are higher. So maybe you've accumulated a lot of credit card debt. Maybe you've accumulated a lot of car note and student loans that you have or haven't paid off yet. You can use those funds to pay off all your debts so that you don't have those debts anymore, and maybe put a little bit of cash on the side as well, so you have enough left over to put 10 or 15,000 on the side to just get through this recession inflationary period that we're in or heading through. So you can also use it to purchase another home as well. You can take all the funds from your home and use that for the down payment and closing costs to go purchase another home and qualify for that as well. So a lot of anything pretty much that you want to use your cash out refinance funds for, you can use them for. Some of the cons, you're going to owe more money on your home. So if you had a home that you own free and clear, and now you're going to take the cash out of it and refinance it, now you owe money on that home. So no surprise there. And if you owed $150,000 left on your mortgage, but you got $300,000 in equity, and you want to take out $80,000, okay, now you're gonna owe that 150 plus that 80, which gives you $230,000 that you're now gonna owe on that home. So no surprise, but now you're gonna owe more, and that's going to increase your monthly payment for the home. But also, what you use those funds for could help with decreasing other debts as well. And so there are closing costs associated with a cash out refinance. So I'll wrap it up with that. And again, that is all that I have. I will stop sharing my screen here. Check the chat, see if I don't see any questions in here, but that's what I'll wrap it up with. So thank you for stopping by and tuning in. Hopefully you were able to get something beneficial from this. And if you have questions or anything, please feel free to reach out to me. You can follow me on social media. I am GA Loan Officer on Instagram and TikTok, Frederick Middlebrooks on LinkedIn. So hopefully you were able to get something beneficial and useful out of all of these different ways that you can creatively finance the purchase of a home. And like I said, always feel free to reach out to me anytime, and I am more than happy to help assist or provide guidance. So that's all I have for you. Have a blessed and wonderful day. Take care.